Data beats gut feel by a million miles because we have no memory of bad gut. We only have memory of good gut.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Agostino. If you ever sat down to study a rental market, if you haven't, then you're missing out on an important piece of the investing puzzle. The city and even the area you invest in can make or break your deal. Finding and selecting profitable and sustainable rental property is absolutely key to your real estate investment strategy. Well, today's guest understands how to do this very, very deeply. Early on, he leveraged his technology know-how to really analyze real estate markets. And he's been able to create proven strategies to select and invest in the right markets and drive results for himself and for his investors. This has allowed him to raise tens of millions of dollars in real estate funding and currently holds over 1,800 units, projected to be over 3,000 units in the next 12 months. Now, this includes a portfolio of multifamily, student housing properties in 8 states across the nation. So today, as a CEO and founder of Grocapitus, he currently negotiates and acquires commercial properties for his investor pool. It is through this platform that he looks to share everything he's learned throughout his journey with the next generation of real estate investors. Now, with all that, I'd like to welcome my good friend, Neal Bawa, to the show. Neal, thanks for coming on, bud.
Thanks for having me back on the show. I'm very excited to be here.
It's going to be great. Now, if you like what Neal has to say, you can reach him via his website at grocapitus.com. And if you like our content, please don't forget to leave a comment and rate the show. And finally, you text the word freedom to 202-410-4202. Get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Neal, go ahead and tell the listeners a little bit about how you got your start.
Mm-hmm. Well, I'm a technologist, right? So I'm a geek. I come from Silicon Valley. I've had a successful tech career, successful tech exit, and I got into real estate in reverse. Most people start with, some sort of flip or some kind of, single family buy and hold rental or maybe private loans. In my case, I started in real estate in 2003 when my technology company decided to build a custom made office campus from scratch for their own use. And the CEO of the company put me in charge of building that campus. And he was brilliant. He helped me a great deal. I couldn't have gotten 10% of the way through without him. And I remember in 2003 to 2004, bitching, whining, complaining about this every day, saying it's not my job. And once it was done, I haven't stopped thanking him for the last 16 years because it was an incredible journey. I find that people that have been syndicating for 10 or 20 years still don't know some of the stuff that I do because you don't typically do those things unless you're building something from scratch. So to be able to build a 27,000 square foot campus from scratch was phenomenal, changed my life. The tax benefits, I was an investor in it. The tax benefits changed my life for the first time in my life. My income went up, my expenses, my taxes went down. That by itself was a huge aha moment. We ended up building or partially building 6 of those campuses in California over the next 10 years because it also pole vaulted our company into the next level. We had this exquisitely built campus optimized for profit, but also very good looking. And our competitors really couldn't compete with us. So this was a case of real estate not just being a turning point in my life, but also a turning point in my company's life cycle. And it allowed us to exit in 2013, 10 years later, at class-leading valuations. No company of that type had exited at the multiples that we've exited at. I suppose in real estate, you would say that we were at a class-leading low cap rate, right? But in the technology world, we call it multiples. So that's how I got started. And it's I know it's an unusual story, but it then cascaded into a series of interesting, almost non-planned events that led me to becoming, the word I think is micro celebrity in the real estate data space. But that happened over a decade's time. So this was all very slow, very unplanned. But it all started with that one building in 2003.
Right. Excellent. And you're absolutely right, though. Many people, they get started with the flips. They get started with by accident. Some people just start renting out their place, but your approach is somewhat unique. And very similarly, when I was working in IT, I started with developing call centers, and that's where I got my taste of real estate. So, but certainly yours is much bigger and far more lucrative, far more lucrative.
It was extraordinarily lucrative, and the first time we did it, I have a little story to tell about that if you have some time. So, we built the first campus, and it was blockbuster successful. So it's only 2006 now. So it opened in 2004. By 2006, we'd filled it, and we thought we had built it for 5 or 10 years of expansion, but in 2 years we were done. And so now we were like, okay, let's buy this building that's next to us, and it's bigger and it's nicer, but it's like, well, it's 9 million bucks. The other one was 5 million, and we paid cash for it. So maybe we should have leveraged the building. These are not things you think of when you're doing these things. So we were like, okay, let's bring in some investors. And so we knew some doctors, and they were part of the Washington healthcare system that's here in Fremont, California, and Silicon Valley. And so we bring these doctors into a room, and the CEO puts me in charge of doing the pitch. He's sitting in the back of the room making useful comments. And as I'm making this pitch, I'm telling these people how, we're going to buy this building, and I'm going to condominiumize the building into office suites, and everybody gets to own their own office suite, and blah 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 blah. And as I'm delivering the pitch, they're becoming incredulous. On the one hand, they're smiling. On the other hand, you can see my eyebrows going down like that. Their eyebrows are like that because they're like, what's missing here, right? So then they ask me a bunch of questions about splits and fees and stuff like that. And I'm like, no, there's no splits or fees. I mean, we need this campus. We need to build it for our growth. And so eventually I only start seeing smiles. So eventually they ask me and the CEO to step out of the room. So we step out of the room. And so we're standing in the hallway outside, and I'm asking my CEOs, do you think this went well? And he's like, yeah, I think it went well. I think if we can get like 2 of these guys to give us money, that would be great, because the checks that they had to write were 250,000, and we needed 10 checks, right? $2.5 million in equity total, and we would put in the rest. And so we go back into the room, and there's 9 doctors, have 9 checkbooks out. Everybody puts in a check immediately. Everybody just signs on it immediately. They're not even like, I'm going to think about it. They're like, here's the money. And they're all smiling. And I walked out of that meeting feeling like I was in the twilight zone, because what I hadn't figured out at that point, and it took me a few weeks of research to figure out, was they were expecting a huge acquisition or developer fee. They were expecting a 30-70 split, because that was the world that they were in with passive investing. And I hadn't charged anything, nothing at all. I was just simply saying, I need to buy this 33,000 square foot building, and I need to occupy it, but I don't have the money to buy it all. So we're going to buy it in pieces. And then as I need to, I'll move into the rest of the building, and you guys can be my landlords forever, right? That by itself was an incredibly powerful pitch. The fact that we weren't charging any money for all this was phenomenal, right? So my first syndication sale, and I didn't learn the word syndication until 6 years after that, right? So I didn't even know what I did just done. I probably had violated every single SEC rule in that 1 hour time frame, not even knowing that what I was doing is considered to be a syndication. I'm sure my lawyer knew that. But basically, we syndicated a building in about 20 or 30 minutes, didn't charge a fee, didn't charge a split. And so people always say, Neal, why don't you tell this as a success? Why do you always tell this as a success story? To me, it's a failure story. You learn something. And I said, no, that building was so massive in our business. Having access to that building and being able to grow in that building suite by suite by suite over 6 years was so phenomenal that I don't think we could have exited in 2013 if we hadn't built that building in 2007. And if we had built it by ourselves, we would have been so locked down with the mortgage that we wouldn't have spent the expansion money that we spent, right? And that really grew our business. So to me, it was the biggest win of my life, not the first building, the second building, because now, I won because I bought one of the suites. So I had the depreciation benefits, I had the profit benefits. 9 doctors won, and then they became passive investors with me 6 years later when I became a syndicator. Our CEO won personally because he bought 2 suites, and our company won. Our students won. It was a technology education company. So it was a win, 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 win. And you never really see a 5x win with no losers, right? So to me, I think it was one of the biggest success stories that we've ever had.
Well, I think the biggest thing too, or one of the biggest things, something you just pointed out, is that those partners, I mean, they got a deal, obviously. They knew they got a deal when you
Yep.
first pitched it. But those guys, they're still investing in your deals today too, right?
They are, and keep in mind, they're still our landlord, right? So we're talking about an event that happened in 2007. It's now 2020. So 13 years later, the building is still leased out, by that technology business. We sold it in 2013, and then we sold it again in 2019. The CEO and I kept equity in the business, but somebody else came in and took over, and then they sold it for a second time in 2019. So we had 2 cash outs. And those doctors, 13 years later, still have 100% occupancy with the business being their tenant, right?
Yeah.
So imagine owning an office building and having 13 years of uninterrupted occupancy. I mean, that's just bliss.
Beautiful. It's just beautiful. That's great. That's super cash flow right there. But the thing is, though, I think one thing to realize is that inadvertently you didn't get greedy. I think that's one thing, is that you were not so bent up on getting that acquisition fee, or worried about
Yeah.
that big of a split. Many new syndicators are always worried about that. They're always worried, well, what's my piece? What's my piece? Where you were just trying to focus on delivering value inadvertently, of course. I mean,
Yeah,
I don't
yeah.
know.
Honestly, if I go back, I might have charged $100,000, but not a 2% fee. I think that we might have charged something for it, just to anchor the project, right? So I do think that there was a way to improve it. But to me, the value we were adding was to our business and to
Right.
ourselves, because we were buying suites. And so there was so much value to go around. And the deal was so unique in having this beautiful, fast growing, highly profitable company as an anchor tenant on day one, that a deal like that has so much meat on the bone that, you're not nitpicking.
That's right. That's right. And then there's so many lessons to learn from that. I mean, there's many times I've told my students, and even at my events too, I'll say, guys, don't get greedy on your first deals. Deliver value, get something, of course, get paid for your time, but don't get all bent out of shape over it. That's the wrong approach. You need to be delivering value. But one pivoting to your tech now, right? Because I know obviously you were doing a lot of technology.
Sure.
And when you fast forward to now doing your own deals, how did you bridge that gap between understanding the market and applying your technology skills? Like how did you figure out where to find, like where to begin when you really decided to really go into the real estate game full time?
So that's actually the next part of my story. And so, end of 2007, now we're in mid 2008, the building's filled up, all the doctors are happy, we're happy. And I'm really in, like, I love real estate mode, while the rest of the world is just falling apart, right? So I'm telling my family I want to go out and buy lots of real estate, and they're telling me you're the biggest idiot on the planet. We're going to disown you if you buy any real estate, because you're going to basically lose all the money and then come back, us for money. And I'm like, no, 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 you don't get it. I mean, the mathematics of real estate, because by now I was into the math of real estate. I was doing the math. I was looking at yield. I was looking at monthly yields and annual yields. I'm looking at this going, but back in 2005, when this was the shittiest market of all time, you guys were telling me to buy as much real estate as you possibly could. And then the math was telling me it was wrong, wrong, wrong. Now the math says everything's right. And you guys are basically telling me that I'm a moron. So eventually, after talking to my family and not getting anywhere with them, I'm like, you know, the mathematics here is correct. Because, I like to tell people, this is one of the things I like to say. If there is a God, he must be in the numbers, right? God has to be the greatest mathematician of all time. And so I trust numbers a great deal. They are not a substitute for experience. They're not a substitute for boots on the ground. You need to do those things. But when you start without numbers, no amount of boots in the ground can get you to the right place. So to me, I felt like I needed more boots in the ground. I needed to basically do more in real estate that was beyond just structuring deals like office buildings. So I was like, okay, what I'm going to do is I'm going to educate myself on the technology of real estate. There must be people out there that give you this white box, not a black box where I can't see what's inside of it, but a white box where I can basically see this is how real estate works. These are all the different metrics. Coming from technology, from core technology, I expected that this would be widespread. But in 2008, from mid 2008 to the beginning of 2009, I immerse myself into an incredible amount of research, like an ocean of research, and I still can't find one guy out there that basically says these are the key metrics that make real estate in the US work for any class, so single family, multifamily, whatever it is. Couldn't find any people. Now, I did find people that were charging $30,000 for some black box, and there was evidence that that black box worked. But I'm naturally skeptical if it's a black box and I can't see into it to see what the metrics are like. So eventually, by the beginning of 2009, I was like, I'm going to be basically, my niche in real estate is going to be, I'm going to be the technology guy that creates real estate metrics and gives it away. So the first immediate thought was it has to be like Gmail, right? There's no ads in Gmail, right? You just get Gmail, you get it forever, it's phenomenal. And then I came up with a better model, and I said, no, even better than Gmail is Wikipedia, right? So I kind of wanted to be like the Wikipedia of real estate metrics for whether it's single family or multifamily, something that was given away, meant to be given away, had no upside, had no, something that you needed to buy, right? Just a pure gift. And starting out that way actually was phenomenal because it did turn into something that makes me a great deal of money. It absolutely did. And we'll talk about that. But when I started out, the goal was let's build something and give it away for free. And so I started basically doing a lot of research. But as soon as I started doing research, I realized that I wasn't prepared for it because I didn't actually own any property. So I was like, okay, before I do too much research, I first have to go buy some properties. So, but I'm like, but in my story, I have to tell people how I bought properties. I can't just tell them I randomly bought property just to get, experience so I could write the story. So I was like, okay, so what can I do now, right now at the beginning of 2009 with, the world coming to an end, as far as real estate is concerned, what do I do? And so after a lot of thinking, I came up with one single metric. Now, right now we have lots of metrics, but this was one single metric. And I felt from the Rich Dad Poor Dad book, he says, when real estate goes up, it always goes up too far, right? So it becomes bubbly. When real estate goes down, it also always goes down too far. So it becomes undervalued. It becomes well below replacement cost. And he says this has happened like 5 times in the last 100 years. So I was like, okay, we're in the down cycle. So where in the United States has the price gone as far below replacement value as we can? What is the cheapest market in America compared to where they were in 2005? So that became my obsession. And so I go to a Ukrainian hacker. So this guy I've known for a while because he was doing some tech stuff for me. Truly a hacker. I mean, write scripts and inject code, doing all kinds of stuff, and a lot of it not on the level. So I go to him and I say, I need you to mine the Zillow website. The Zillow has 3,300 cities in the US. I need you to mine them and mine every single statistic on every single page. Put them into an Excel spreadsheet and tell me how much each city in America has dropped from its peak, right? And the peaks were either 2005 or 2006, depending upon the cities. And so now 2 or 3 years have passed. Every single city in the US had dropped. I wanted to know how much. So I'm like, I'm like, don't write one of your nasty scripts, because I don't want the FBI coming in tomorrow morning and knocking at my door saying you're trying to hack Zillow.com. And I thought, maybe he listened to me and he's going to take a month and do it slowly. Next morning, and the entire Zillow website arrives in Excel in my mailbox, like this massive mailbox file. And I'm like, for the next month, I was like, is the FBI going to come today? Are they going to come today? But they didn't, because it was public information and it didn't crash the Zillow website. So that was just sheer luck.
And that was in 2009, though, right?
Early 2009, right?
Yeah.
So I go in, I look at the Excel spreadsheet, and I sort it by that column, and it turns out that the city that had dropped the most since 2005 happened to be in my state, California. Surprise, surprise. It was 144 miles away. It was in Central Valley. It was a tiny little agricultural town called Madera, California. It was 20 miles from Fresno. So as you drive out from the Bay Area towards Los Angeles, you're going to hit Fresno at some point. 20 minutes before that, you're going to hit Madera. So it's a Friday. I jump into my car on Saturday morning and I shoot 144 miles down the freeway 5, to Madera. And I go there and I have 2 appointments already made, one with a broker, one with a builder. So I talk to the broker. He says, yeah, there's all these brand new homes. You can buy as many as you like. You can buy sets of 10 if you like for under $1 million. I'm like, okay, great. But he says, but you have to pay cash. You just have to refinance the next month. And I said, okay. Then I go to the builder and I say, this guy just showed me all these homes. Like there's an entire street, multiple streets filled with them. They're completely empty. And he's like, yeah, I know about those. Those are really good homes. And I'm like, so Mr. Builder, how much would you charge me to build this? What is your cost? He says, $200,000. I said, but they're available for $90,000. He said, I know this is the best deal in history, but there's a problem. And I said, so what's the problem? He says, there are no tenants left in Madera. What had happened is this big builder, Kaufman and Broad, came in, bought land for 6,000 units, collected all these agricultural workers that were working outside Madera, and had them sign no-income loans in 2006. So this entire group of 6,000 homes are empty. So there's nobody to rent them. So I'm like, so if I could crack this nut, if I could get rentals, I would have like the greatest deal in history, right? Because I'm buying something that you can't even build at your cost. For $200,000, I'm going to buy them for $90K each. He's like, yeah, but this is much harder than you think. So I drove out of his office and I'm like, instead of going back home, it's 2 o'clock in the evening. Let's just keep going. So I turn in the other direction. I go to Fresno. It's 20 minutes away. And Fresno, so many realtors. So I just randomly go into one of the realtors' office. He's sitting there. We talk, and a plan begins to develop in my mind. And this is exactly how my mind works, and this is why I'm called the mad scientist of multifamily. I'm devious. Like, plans appear to me. I don't know why, but they appear to me. You should check out some of my videos. So so I speak to the guy and I say, okay, you know what? I would like you to sell me a home here in Fresno. And I do not want that home to be new. I want it to be at least 15, 20 years old. So he's like, okay, well, I have plenty of occupants, vacancy. And I say, don't make it 4 bedrooms either. It has to be 3 bedroom. So by now he's getting curious. He's like, I have so many brand new 4 bedroom homes. Why do you want to buy an old 3 bedroom home? I'm like, trust me, just get me a good deal on one of these. So on Summerfield Lane in Fresno, he shows me a home later that day. It was, open house. So we just walked in and looked at the house. It seemed reasonable. The rents were in line. Everything was good. So we put that home in contract. And then I go back to the Ukrainian hacker on Monday morning and I tell him, and this may have taken a week or so, but I'm going to tell it in a compressed timeline. So I go back to the Ukrainian hacker and I say, I have this property called Summerfield, on Summerfield Lane in Fresno. Can you generate like 20 or 50x the tenant leads for this property that it typically would need to get rented? And he's like, why do you want to do that? I said, well, because I need to redirect leads. He's like, okay. So he says, I pay him a few $100s. He goes and researches, comes back with this god awful list of websites that now everybody knows, but back then people didn't. Showmetherent.com, rent.com, Rentler, all of these kinds of places. So there's these dozens of websites. And he said, I think I can hack them all. And I said, why do you need to hack them? He said, well, normally you only get one listing per site. But if you want a mountain of leads, you need to figure out how to get 10 or 20 listings. So you have to basically game the system somehow. So I'm like, okay. And I'm a technologist, so this was naturally interesting to me. So we basically worked on it together for the next month, and we figured out how to pretty much hack all of the sites. Some of them, if you put a semicolon after the home number, it basically considered that to be a different home. Some of them would simply allow you to have fictional addresses. So if my property was 35216, I would put in 35217. It would warn me, but it wouldn't stop syndicating. It would still push those listings out to all of their syndicated sites. So we did lots of that. Then we came across Craigslist, and we basically wrote a script on Craigslist so that every 2 hours it would put a new ad on Craigslist and take the old one off. Right? So every 2 hours we'd have a brand new Craigslist ad. All the ads had different email addresses, different phone numbers, all of those sorts of things. So we're getting like 50% of our leads from Craigslist because we were putting ads in every 2 hours. And you might say, why every 2 hours? Well, because a Craigslist ad is only visible for 2 hours. Then it's on page 5. Nobody ever sees it, right? So we had to have an ad every 2 hours. So he's got all these people in the background in the Ukraine doing all this stuff. And within a week, I have this incredibly large mountain of leads, like huge number of people want to rent this property on Summerfield Lane. And so now I go and hire my first virtual assistants. Now I have 18 full-time virtual assistants that work for me. They all work 8 hours a day. And this was the first, right? So this lady in the Philippines, I give her a phone number using a service called Ring Central. And I say, okay, you're going to get this huge number of leads coming to you. As soon as a lead comes in, call them back and say this to them. Tell them this Fresno property looks like it's rented. I have 10 more properties. And they're like, okay, we'd like to see those. Yes, but they're in Madera. Oh, no. We don't want to go to Madera. It's 20, 30 miles away. I don't want to deal with Madera. Would you still consider going to Madera if we give you a $50 Amazon or gas card? All you have to do is visit the property and come back. As long as you go and meet my agent, walk through the property and come back, we'll give you $50. And most people thought that I was some kind of, Nigerian hacker scheme. So they would just yell at us or cuss at us or hang up, right? So 9 out of 10 would do that. But the 10th person was actually intrigued. So it's like, so you have these real buildings in Madera. You're going to walk me in there and show me these buildings. How bad it could be. I mean, how could you be a Nigerian hacker if you're actually showing me buildings in Madera? So every 10th person would agree. So now this lady is setting appointments with this guy that I hired in Madera as a property manager, and he's basically showing people these properties. And as you can imagine, Agostino, these properties are 500 square feet larger. The rent is $500 less. They're brand new. Nobody's ever lived in them, right? So everything looks gorgeous. Stone on the outside, 2 floors. I mean, what's not to like? Obviously, you have no neighbors because everything's empty, right? So there's that disadvantage, and some people didn't buy it because of that. But 30 days later, all of those properties are rented out. And What's amazing is that some of them we rented out before we bought them, right? Because the banks were so flexible, right? You could put a property in contract and tell them, I'm trying to find a tenant. Banks were really up shit creek, right? There's 6,000 empty units, right? So, I mean, once it's all done, I have $14,000 worth of cash flow every month. And I can tell you it was still small compared to my big fat tech salary. But the impact that it had on my life was outstanding because normally, and you know this because you come from technology, we're always very paranoid, especially the big fat salary guys like me, that the boss is going to replace us with three young dudes or three young
Yep.
gals.
I was
Right?
there.
So we,
I
we
was
work
there.
like crazy 15 hours a day, and then we work Saturday, and then we send emails to the boss on Sunday just to make a point that we're working on Sunday. And so it burns you out, right? And I was burning out after 10, 11 years of doing this kind of madness. And that day I felt liberated because I went back to my boss and I said, I've had 10, 12 years of burning the candle at both ends. I can't do this anymore. From now on, I'm going to work 10 hours a day. And my boss said, okay. And I'm like, okay, so what? He's like, no, I'm okay. I'm fine. And so for the next 5 years, from 2009 to 2013, until we sold the company, I worked 10-hour days. I would have never had the balls to say that to him if I didn't have $14,000 of cash flow protecting my life. So it changed my life forever.
Yeah. Yeah. Now, all those tricks that you mentioned, you can't do those tricks anymore, by the way, guys out there. If you're,
That's right. Yeah,
there's a techie
tricks
listening
have
to me.
changed. The tricks have changed. There's more tricks that there's certainly less tricks that you can do. Some of these websites were new, and so there was all kinds
Yeah.
of stuff that you could do, but we still do many of them. So now that I've got these 10 homes done, right? I'm legitimate. I'm a legit real estate investor technologist, and I had a story to tell that was completely true, and it was wonderful, right? People are like, "Oh, wow!" And so people start calling me to meetups, and they start calling me, to the podcast or the predecessor of podcast webinars, things like that. And within the San Francisco Bay Area, I sort of become a little micro celebrity. People are really curious about this guy, Neal Bawa. He's just a technologist, but he still does meetups. He still does all this real estate stuff, but he doesn't have anything to sell, right? He like, what's Neal Bawa's product? Neal Bawa's like, I don't have a product. I'm a tech guy. I run this business that you're standing in, because a lot of the meetups were inside our campuses. We had large classrooms, so it was awesome being a meetup leader because to go to my meetup, I had to walk 75 feet, right? So, and walk into a classroom and boom, here's my meetup, right? So I'm having so much fun and still haven't figured out a business model, but one is beginning to emerge. And the first thing is, by this time, my CEO is getting old. He's like, we're going to sell it in the next 2 or 3 years. So I'm like, okay, so once we sell it, I'm not going back to technology. I think 16 years of tech is enough. And I'm beginning to think, I'm beginning to get people listening to stuff that I'm doing. Now's the time for me to develop that white box system. And so I jump into it. I go back to the Ukrainian hacker. He refers me to a statistical genius, a statistics genius, right? And so we use the Ukrainian hacker. We mine not just the Zillow website, but this time we do the Bureau of Labor Statistics, the Census Tract, website. We mine them all together, and then we correlate it to real estate profits, because you can use websites to see how much money people are making on homes in every market in the US. So we correlate that to profits. And we try and figure out what are the 800-pound gorillas that make real estate what it is, especially on the appreciation side. But anytime you get appreciation, homes get more expensive, rents also go up, right? So rents go up as a correlation to appreciation. And so after about a year of study, we find that there are 5 main metrics that affect how good a city is for real estate investing. 5, right? And surprisingly, schools are not one of them, and I'll explain why. And then there are 5 that affect how good the neighborhoods are. Because you can be in the most awesome city in the US to invest in, and invest in a shitty neighborhood and still lose money. That happens, right? So bottom line was, you needed to know the best cities in America to invest in and the best neighborhoods. So after I did this research, I put it together into a system called Real Focus. And then I basically gave it away for free. It's completely free. I mean, Agostino could put his name on it and call it the Pintus Real Focus System, and I wouldn't sue you, because it truly was meant to be a gift. So you can go and charge $10,000 for it if you like. And some people, hint, hint, already are, right? They're charging people, calling it their own system. They know that Neal's never going to sue them. To me, I think the amount of fun that I had putting it together was enough of a blessing. And it did gain me a huge amount of notoriety in the real estate space as this mad scientist who's constantly working on these kinds of numbers. So each year the system improved, and we finally put it together as a package that we give out to people with an Excel spreadsheet, and they never have to come back to us because there's nothing to buy. And the 5 metrics, if you want me to mention them, I can
Sure.
briefly talk about them.
Yeah,
So the
yeah.
first is um, population growth, right? And not just population growth, but a certain amount of population growth. And we don't have enough time to discuss the specifics of it. So I'll just point you to the course. It's free. You can take it, and they don't even give me your email address, just so you know. So I'll point you to the course. But a certain amount of population growth is very highly correlated with real estate profits. A certain amount of median income growth, a certain amount of job growth, a certain amount of home price growth, and a certain amount of reduction in crime. These were the 5 big ones. And you notice that each time I say this, I say a certain amount. Well, yeah, because if you have too much growth in home prices, that market becomes bubbly. So, like everything else in life, there's a Goldilocks zone. Not too hot, not too cold. Markets that get too hot, like Boise is right now, eventually you'll suffer, even though everything else in that market is right. It's just too hot, right? You will still get burned. So we discovered through data the Goldilocks zones that make sense for each of these metrics, and we published them. We also threw schools in, but it didn't change the data. We ended up with the same exact list of cities with or without the schools. So we took the schools back out because we found that the other 5 somehow magically, automatically in the background were compensating for the schools. As you can imagine, if an area has high incomes, it's probably going to have the best schools, right? Or better schools, right? So an area that has very low incomes is going to have the worst schools. So we ended up getting the benefit of schools without actually throwing schools into the real focus system. I'm sure that there's an influence of schools in there anyway. So we did that. Then we designed 5 for neighborhoods. So we came up with others. We found that with neighborhoods, again, you had to look at their income. But again, you were in a Goldilocks zone. If the income was too high, the cap rates were too low, there was no cash flow. So you were basically buying properties just for appreciation, which I think is a bad idea, right? So you had to be in that Goldilocks zone. Then we looked at poverty levels. Then we looked at the unemployment level of the neighborhood in comparison to the metro, because you couldn't really compare it to national unemployment. So we found a way of comparing the neighborhood's unemployment rate to the metro's unemployment rate so that it was in the Goldilocks zone. Usually the areas we went to had higher unemployment than the city, because we were looking at, we were looking at like C plus areas, B minus areas. And so there were areas much higher than them. The A areas and the B plus areas always had lower unemployment. And so it was common, if the city, Columbus, Ohio, was at 3%, the area we were in was 4%, but not 7, not 10, right? So we knew where to stop and still get the cash flow and still get the appreciation. So we put the system together. I stick it on my website, and I don't know, 100 people a year, 200 people a year are taking it, and they're telling me that this is the best thing they've ever seen. Like, the reviews were ridiculously over the top, right? People are like, I can't believe that you're giving this away. I would have paid $10,000 for it. So then I go and ask my community of people through my meetup. It's like, I've got this really good thing. I don't want to charge people for it, but I would like to have not like 100 people a year take this. I'd like to have 10,000 a year take this. How do I make that happen? And somebody, like, the very next day gave me the idea that really changed things for us. He said, if you're truly giving something away for free, put it up on udemy.com. Why do you need it to be on your website? So I said, what's Udemy? He says, Udemy is the largest online course portal in the world, 90 million, registered people, lots of people taking courses, both free courses and paid. Make yours free. So I go to udemy.com, I upload the course, and I'm like, if I can get, a few hundred people every year from here and double my yield, I'll be happy. And it just went supernova, right? So if you go to udemy.com, udemy.com/realfocus today, you will see 6,000 people taking the course right now, right? So they're currently somewhere in the course. There's 600 5-star reviews. It is both the most popular real estate course on Udemy and also the best reviewed course. And I think that it's not because I'm awesome, it's because it was completely free.
I think it is
right?
because you're awesome, though, for
No,
real.
I think it was more that people felt that there was no, vested interest there. Udemy doesn't give email addresses out. And so oddly enough, though, people loved it so much that they would then Google my name. And as it happens, I'm the only Neal Bawa on the World Wide Web. I'm the only Nealbawa on Google. And so people would find their way to my website. And now my website had huge amounts of traffic all coming in from this Udemy website. And it resulted in my customer database. I had nothing to sell at that point, but I still called it the customer database, growing by leaps and bounds. All of a sudden, I had huge numbers of people, and they were all saying, whenever the heck you invest in something that you allow investors in, we'd like to invest with you. And so this is the last year. We're still prepping our company for sale. And I'm like, I think I have a database. And I didn't know what the value of this database was. I thought maybe, I can do a deal or so. The database was much larger than I thought it was. And those people really loved what I'd done. And so when I switched over to becoming a syndicator, I've now raised $100 million, done 23 deals. And I did, 7 of them with another company that was a minority partner. I then realized, wait a minute. I mean, all of these are my investors. So why don't I just do my own company? And so we've done 16 projects um, worth $320 million under my company. And then we had done 7 worth $150 million. So one more deal and I'll hit a $500 million number. And that's how big that database was. I mean, I had no freaking clue. And all this stuff sounds planned, but it happened over 10 years in a completely haphazard, unplanned manner. Certain pieces of it were out of sync from what they should have been. But I had all the time in the world because I had a tech salary and I had this place in Madeira that was giving me the cash flow. So I didn't have to worry about the cash flow. I had the tech job. So I just kept doing this stuff. And hence the moniker, the mad scientist of multifamily.
Right. Well, but I also think too that at that time, and even today for that matter, the application of data is still one of those things that very few people actually do. A lot of them go by gut. A lot of them still look at the usual suspects like city data and spot crime or
Yep.
whatever.
Yep.
Which is fine, I guess if you know your area, but your approach is somewhat unique. And I think that's I would imagine that's probably the reason why people just gravitated towards your course, aside from it being free, of course, but all the other stuff too, right?
I think so. I think a lot of it is it is extremely detailed. It's extremely specific, but it also tells you when to give. So there are 5 real focuses. I often invest in areas where there's only 4 thumbs up and there's a thumbs down. So I explain to them which rules to break, which rules to bend, which rules never to mess with. Like any the neighborhood rule that says never go into a neighborhood over 20% poverty level. I have never messed with that rule because I know that the delinquency that you get above 20% poverty level means you'll never make any money. Doesn't matter what the cap rate of the property is. You could buy it at 15 cap. You're not going to make any money because that property truly makes no money on an ongoing basis. Its delinquency is too high. Its churn is too high. Your expenses are going to be through the roof. So you can never really make any money at all. And so I told people which rules had severe consequences and which rules had not so severe consequences. And then people saw me do that, and they saw me do something truly painful. Agostino, when you're data driven and you're giving people lists of cities, best cities in America to invest in, obviously those cities change every year. So in Jan, I would do a webinar, 5,000 people would watch this webinar, and I would have my list of cities. But it would then force me to walk away from cities where I had built my forts and my properties, and I had all these connections and all these resources, and I was basically forced to walk away from them. So I'm the only syndicator that I know of in the entire industry that has properties in 10 states. So, right? So people saw that because they knew that that was extremely painful to kind of rebuild, your connections 10 times in 10 different states. But the data said that, so we followed the data, right?
Right.
And right now I'm spending all of my time trying to add an 11th state. Just so you know, we're recording this in September 2020. In my mind, the greatest state in America is one that if I gave you 10 tries, you wouldn't pick one. It's Idaho. And you're
Huh.
like, what? Idaho? All right. Google Idaho and what's happening in Idaho post pandemic. for 15 minutes. And you'll go from Idaho to Idaho, right? Because it's just amazing stuff happening in the state of Idaho. It was already pre-pandemic the fastest growing state in the union, but post-pandemic, because it had the city of Idaho Falls is the only city in America that gained employment through the pandemics.
Wow.
Right? It has gained jobs because it has billion-dollar government contracts that are triggering, right? Things like that change everything, right? So you have a city at 4% unemployment after 5 months of coronavirus, right? They can't find people. They're moving, shipping people from Boise 200 miles away because there's so many projects going on. Stuff like that happens in America all the time. And nobody can actually find them unless you're constantly studying the numbers. And City Dash Data doesn't give you those numbers, even though City Dash Data is a phenomenal website if you know where to look, right? So it's kind of a counterproductive sort of thing. So what we do first is we buy housingalerts.net. That's one service that we pay for. Then we pay for local market monitor. So these are two services, two completely different viewpoints, but we like both of them. And then we look at the neighborhoods using a third paid service called Neighborhood Scout, right? And then we use city data for cross-referencing our data just to make sure that nobody's making some stupid mistake, right? And then once we go into the marketplace, then we use CoStar because we're multifamily people and you can't really live without CoStar, right? So you have to have access to CoStar reports. But CoStar really doesn't matter at a national level. I think these other reports do a better job. But once you get into a sub-market, CoStar is king, right? So when we look at the data, it often drives us in amazing directions. I mean, I have properties in places that you've never heard of, like Dalton, Georgia, right? And you're like, where the heck is Dalton, Georgia? Well, actually, it is a market that serves Chattanooga, which is in Tennessee, but it's on the Georgian side of the border. It's a small town, 35,000 people. It's the carpet capital of the world, now the laminate capital of the world. And it's an extraordinarily good market. This property, we bought it from the Coca-Cola family 2.5 years ago. Occupancy pre-pandemic, 98%. Occupancy post-pandemic, 98%. And we've had $1,500 in delinquency and bad debt in 5 months because nobody wants to leave, even though they can choose not to pay us. They know we will evict them at some point. Georgia is a very landlord-friendly state, so as soon as we get the choice, we'll get them out. So nobody wants to leave, so nobody wants to stop paying us. So I mean, that's what data does. I tell people, use data to become lazy, right? And people are like, what are you trying to prove? I'm saying I'm not trying to prove anything. It's true. Use data and you can be lazy. You do less and you get more, right? Because that's what the data does. But up front, you have to be very careful with the data, right? Up front, you have to be very tied to it. Make sure that you don't tell yourself a data story. Because I've also seen people do that. They will handpick all the good stuff out of a metro, ignore all the bad stuff, never tell their investors about all the bad stuff that's happening. And they're not deluding their investors. They're actually deluding themselves. Because in the end, they're buying bad properties in bad markets, right?
Yeah.
Worst that can happen to the investor is, he might not make any money. You might just barely return their principal or maybe make 5%. But you gave away 5 years of your life simply because you pulled wool over your eye using selective data.
And that's a key thing right there too, for many guys listening out there, is that don't talk yourself into getting into a bad deal, right? Even if, because the numbers are going to tell you right away, if you choose to ignore those numbers, because I know people have done this, they really want to do a deal that bad, that it's a great deal, they're going to do it. And just like you said, you're going to waste a whole ton of time trying to fix it, trying to finagle it, trying to make it work. And it's going to cost you nothing but time and possibly even a lot of money if it's losing money, So it's just, you don't want to do that. Absolutely not. Yeah, that's good. That's very good advice. Now, Neal, if someone's listening to this right now and you have to give them a piece of bulletproof advice, what would you tell them?
I'll give it to them in two different ways, but it's the same message, right? So if you want the short version, it is that data beats gut feel by about 1,000,000 miles. Data beats gut feel by 1,000,000 miles because we have no memory of bad gut. We only have memory of good gut, right? We don't remember our mistakes when it comes to the gut. So data will always beat it. A humorous way of saying it, and this is kind of the favorite saying that I've invented, is that the Bible was wrong by one letter. It is not the meek that shall inherit the earth, my friend. It is the geek.
Love it. Love it. Love it. All right, guys, if you want to reach out to Neal, get to him through his website at grocapitus.com. I hope you got some great insight on how to apply data and technology to select your markets among many, many other things. All right, this is definitely great stuff. Thanks for tuning in, and I'll see you in the next episode. Take care.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.